Why betting on black swans doesn't work. Black swans are always on everybody's mind here. It's that thing that hangs in the back of your brain. If you've got money in the stock market, you're constantly worried about this black swan event occurring and maybe messing up the year that you want to retire by, or messing up your trading, how you tend to deploy capital in the market. But then also there are a lot of people who, learn about how they can actively trade and manage their money, learn about black swans and black swan funds, and think to themselves, I'd like to try that out. And of course, I don't want to jump on here necessarily and say, this strategy never works, or you can't do that. Of course, on any given day, any given year, something can work out. But black swans are very, very tough to invest in or bet on, whatever you want to call it, from an individual investor standpoint. We're going to point out a couple of reasons why that is, using the S&P 500 in just a second. But first, I want to let you know what a black swan is. Extremely rare events that can have widespread, often negative effects vis-a-vis a stock market crash. In trading, they can be difficult to predict, but have large potential for profit. And so how do you situate a black swan in a trading platform? What does that tend to look like? Well, in the stock market, this tends to look like a crash. And when you're trying to trade based on a crash, you can either short the market, which, as you can see here, leading up to the most recent black swan-like event, the outset of the pandemic in 2020. If you were to be short that market, even from, let's say 2018 or 2019, essentially pretty good timing, holding short positions as the market goes up and goes against you can be not only very costly, but it can emotionally be very difficult to deal with on an individual level. And if you just look at the long-term trend of the stock market, on average goes higher, historically speaking. Of course, the stock market can do whatever it wants, but historically speaking, the stock market on average moves higher by 6 percentage points, 7 percentage points, depending on where you're looking. And so shorting that market, not necessarily a great strategy, given that information, like I say, can be very tough. Not the best way to necessarily bet on a black swan. What a lot of black swan funds or black swan traders will do is buy out of the money options. In this case, if you're betting on a stock market crash, buying a 2, 3, 4, 5 delta put as a black swan is obviously a rare occurrence, and so a 2 or 3 standard deviation put, which would be in the 1 to 5 delta range, that would be closer to a black swan, at least in my definition. And so you essentially either have to be short this market or be buying these puts for, in the case of the last black swan, between 1 and 10 years, waiting for this crash to occur. And I was checking prices, and of course, these are all theoretical values. I can't necessarily go back and back test this, look at a bunch of this, but you get the moral of the story here. If you're buying 3 delta puts that are priced between, $5 and $20 bucks in terms of the S&P 500 index, and that's on an annual basis, you're doing that for years, and then you finally get this $1,200 crash in 2020. You're really bleeding capital waiting for that. And so you have to have a big bankroll to consistently bet on that black swan, waiting for it to occur, because they're so unpredictable. Hence, that's the whole idea of this thing. And then I also want to look into this most recent occurrence of a black swan event, so to speak, because you have this collapse in the stock market in 2020. Yes. And if you were buying 5 delta, 3 delta, 1 delta puts, in 2019 and 2020, then they absolutely increased in value in the midst of this crash. But this market bounced back very, very quickly. And I was taking a look at it. Theoretically, at the start of 2020, the S&P 500 is at about $3,200. The 3 delta put would have been about the 2,200 strike, and the S&P 500 collapses right to around that range. And of course, like I say, at that time, if you had, let's say, bought that 2,200 put for $15, and the market collapses down there, you're probably up, 500, 1,000% on that $15, as that's the now at the money put strike. The market's collapsing and implied volatility is juiced at the time. And if you get out there, that was a great trade. But if your strategy is essentially to bet on a black swan, buy that put, and hold for the market to really collapse, and hoping that put is in the money by hundreds of points, the market not only bounces back very quickly, so you had to time it really well. The market ends up being green on the year. It returns in 2020 positive. And so obviously that trade wouldn't have been profitable, not to even mention that the market collapses by, 30% from 3,200, 3,400, all the way down to 2,200. And that's only when you start making money on that put. Like I say, if you bought that thing and sold it when the market was down there, absolutely profits in there. But it's so hard to buy options, let alone 2 or 3 standard deviation options, betting on a black swan, consistently cough up that money year after year. And then when it occurs, you really have to time it well, because the black swan event pretty much only gets the market down to that strike. You almost need lightning to strike twice, 2 black swans on top of each other, essentially, to make it really worthwhile there. And then also, let's say that you are just waiting for this event to occur, and then you'll trade with it. You can really see a lot of losses trying to jump on board a black swan, because not only are they so unpredictable, but when they reverse course is also very unpredictable as well. We saw in the financial crisis of 2008, the stock market falls by 30, 40% and stays low for months and well over a year before recovering. Here, the pandemic crash, it was a matter of 6 months before the stock market got back to where it was prior to the crash. And so if you time it incorrectly, of course, if you sell the S&P in the midst of this free fall and then buy it back right at the lows, that's a great trade. But the unpredictable nature of these black swans, so difficult from an individual investor standpoint, whether you're shorting the market consistently, jumping on board to short the market as it's falling, or consistently buying 2 or 3 standard deviation puts. Very, very tough to time out, and can be a huge draw on capital. Probably better off looking at a more consistent strategy like passive investing, or other option strategies that consistently perform, maybe even betting against black swans, as they are so rare. And historically, the stock market has tended to bounce back. Of course, strategy is up to you. And the great part of financial markets in general, but also when you get into the derivative space of options and these more active strategies, is any strategy can make money, right? You can be the guy who's selling the put to the black swan trader, and the black swan trader can buy the put, market falls, they get out at the right time, they make money. The guy who sold the put is, rolling that out in time, the market bounces back, he makes money. Any strategy can make money. Black swans, though, very difficult to time, both on getting in prior to the crash and getting out for the best profits possible.